Ladies and gentlemen, the world is currently witnessing a major conflict, a conflict rarely discussed openly, yet its consequences are felt across nearly every nation on earth, a confrontation between political power and monetary power. In the United States, this conflict has surfaced publicly. The President of the United States now stands in direct opposition to his own central bank governor. This is no longer a mere policy disagreement, but an institutional crisis, shaking the foundations of the global economy. At the center of this storm stands Jerome Powell, a figure long considered untouchable, now under global scrutiny. The question is simple, yet profoundly fundamental. Is the central bank still a guardian of economic stability, or has it become an absolute power, a state within a state? More importantly, why does this conflict matter to Indonesia? Because what is unfolding in America is, in many ways, happening here as well. Central banks are built upon one foundational principle: independence. Independence from political pressure and short-term interests. Yet in practice, independence without accountability often gives birth to absolute power. In the United States, a central bank governor serves a 14-year term, far longer than any presidential mandate. When a president seeks growth, job creation, and economic expansion, the central bank can instead choose to restrain the economy. This is where the true conflict begins, not a personal dispute, but a clash over the nation's economic direction. The United States now carries public debt exceeding 130% of its GDP. Every year, trillions of dollars in debt reach maturity. Under these conditions, interest rates are no longer technical tools. They determine the fiscal survival of the state itself. The president's logic is straightforward. Expensive old debt must be replaced with cheaper new debt. Yet this logic collapses when the central bank refuses to lower interest rates. This is the core of the monetary power struggle. Manufacturing can only thrive when a nation's currency remains competitive. A weakening currency is not always a sign of weakness, but often a deliberate economic strategy. Interest rates are the primary weapon in this strategy. When central banks hold rates high, domestic industry suffocates. Indonesia faces the same paradox: low inflation, yet persistently high interest rates. The government seeks aggressive economic growth, yet credit remains expensive. Large sums of capital fail to reach productive sectors, instead circulating back upward. As a result, job creation stalls. Independence without oversight is a latent danger to any nation. History repeatedly shows that unchecked monetary power ends in crisis. Reform is not about weakening institutions, but restoring their original purpose. The conflict in the United States is a mirror for the world. Economics is not merely about numbers, but about people. The choice now lies with us. Who truly holds the power? Because the future of a nation's economy is determined by the courage to act today.